We're going to talk about Visa today. So, this is one of the strongest companies in the markets. It's a dividend payer. Doesn't get talked a lot about in the dividend world because the yield is very, very low, but we're going to kind of break all that down. So, we're going to talk about the company. We're going to go kind of from beginning to end, talk about how the business makes money, the financials, maybe some valuation, and the dividend, of course. And we'll just kind of go from there. So, yeah, let's go ahead and start. All right. All right. So, three questions, one stock. So, number one, let's figure out how Visa actually makes money. Not a lot of people know this. We'll take a look at if the dividend is actually as small as it looks. And we'll also talk about what a fair price is today. So, that's what we'll be taking a deep dive into. All right. So, Visa. Most people have heard of Visa and MasterCard, understand maybe kind of what it does, but maybe I thought we could spend a few minutes just kind of going through the company and how it operates, what it is. So, Visa and MasterCard, they can be kind of interchangeable. They are a toll on every swipe. So, what happens is that when we go to make a purchase, whether it's online or in a store, and we use our debit card or credit card, the process is fundamentally similar. So what happens is that you go and you swipe your card to buy a coffee at, let's say, Starbucks. That's an easy example. And what happens is that process goes through two layers. The first is an authorization, and that takes roughly 1 to 3 seconds, give or take. And if it takes longer than that, we think it's, the end of the world, or we start wondering if there's something wrong with our payment or with the card or whatnot. So what happens is that at the processor or at the terminal, when you swipe your card, the process goes all the way to your bank and then back, and that all takes 1 to 3 seconds, give or take. And you're authorized to pay for that coffee at Starbucks, and you can walk out the door. Later, the company Starbucks will process all the batches for the day for all the debit cards and credit cards that are processed. That goes into a batch which gets sent to the bank, gets authorized, the money actually gets pulled from the bank, and then that gets deposited into Starbucks's bank account, and that's how the whole process works. And that's why a lot of times when you look at your bank statement or you go online, bank statements are an old fuddy-duddy thing now, I know, but when you look at the older when you look online, sometimes you may not see a transaction hit your account for a day or 2 or 3, and it's because of all this processing that happens behind the scenes. And so what happens is that Visa, enables all of these things to go from the credit card processor or the terminal in the store to your bank and then back to the store, and then later for that money to get pulled from your bank and deposited into the merchant's account or Starbucks in this case. And so that's what Visa does, and that's through their system called VisaNet, which was built back in the 1970s. So, one of the common misconceptions about Visa and MasterCard is that they are a credit card or a debit card. They are not. What it is it's a brand or a scheme that's on the card that's issued from your bank. So, if you bank, for easy example, JP Morgan Chase, then you have a Visa or a MasterCard on your card, depending on who they process with. And they have contracts with MasterCard, for example, and then your card will be branded with a MasterCard. And then when the card is used, that's how it's all transferred. But the actual money, whether it's a credit card or debit card, comes out of your bank. And Visa and MasterCard have zero to do with the actual money transferring back and forth. They're just basically a toll road that allows all this to happen on the rails that happen behind the scenes. And so a lot of people think, oh, I got a Visa card. I got this great credit card. Yes, you probably have a great credit card with JP Morgan Chase, but not with Visa. That's just the brand. And that's a very common misconception. And this will come into play as we talk about some of the risks down the road with what's going on with Visa and MasterCard. So one number that I really want to point out is they did 43 billion in tolls collected last year. That's a really easy way to think of it. So money that they collected from the transactions. Now, the transaction itself, the Visa, when you swipe a card for $100, the merchant gets around 97 to $98 of that, and that's because of the fees that are charged along that toll road. Now, Visa does not get the vast majority of that. That's another common misconception. The majority of the money actually goes to the merchant bank. So JP Morgan Chase in our case, they receive roughly 2% or so of the transaction. So they get the lion's share of the money from the transaction. And the reason for that is because they are the ones that are assuming the vast majority of the risk in the transaction. So if they tell Starbucks that, yeah, your $100 worth of coffee, which is a heck of a lot of coffee, uh, is guaranteed to be paid to Starbucks. And if the card fails or the user takes more money out and they can't fund the $100, then JP Morgan Chase is on the hook to Starbucks for that money. And so because they assume the bigger portion of the risk, they get a bigger portion of the pie. Visa and Mastercard actually only take, pennies on the dollar of the transaction. So it's a very small amount, but because they are the backbone of most commerce transactions online or in person, with them controlling 98% of the cards being used in payments, then they collect a lion's share. They collect a lot of money, as we can see, with 43 billion. So that's how Visa makes money. I guess the simplest way to say it is they're not a credit card. They're actually a toll road that allows electronic transactions to happen online. So I hope that makes it sense. So one of the reasons why they are such an amazing company is the profit margins. And they are probably in, if they're not the most profitable, they are in the top 5 or 6 of the most profitable businesses on earth. And as we can see here with the slide numbers, 98% gross margins, 61% operating margins, 52% net margins, and 49% free cash flow margins. So basically that breaks down. So every dollar of sales that they accumulate, they generate 50 cents, almost 50 cents of free cash flow from that. And that is unreal. And to put that in perspective, a monster company like Walmart, who is processing 750 to 800 billion in revenue, generates around 4%, 2 to 4% income margins. So their net income is very, very, very thin. Costco, famous for their very thin margins, 2%, 1.5% net income margins, very, very small on a huge base of money. So although Visa and MasterCard process far less than those retail monsters do, they generate far, far more profit from the companies. And in large part, that's because of the system that they built. The Visa net that they've built is the technology needs to be updated, of course, but it doesn't need to be continually renewed or rebuilt, kind of like what's going on with semiconductors and AI right now. And so that is why these companies are so hugely profitable, and that is why they are so attractive to investors like myself and maybe you. All right, so we talked about the revenue, 43 billion. The revenue has more than doubled in the last 8 years. So the revenue CAGR over the last 10 years is around 10 and a little over 10%, which for a company that has been around since the 70s is very impressive. They grew 11% in fiscal year of 2025. I do want to mention that the data that we're going to be using today is all being powered by fiscal.ai, which is one of the two tools that I use to do any sort of analysis on companies. They're very, 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 very fast, very, very efficient. They have the best charts, and they have great, accurate numbers. So, one number I want to point out when we're looking at this chart, look at 2020. If we all remember back during the pandemic, the company, like everybody, took a hit, and they dropped about 5% that year, which for a global payments company is pretty amazing considering the world stopped moving. We still had to pay for stuff, but the world stopped moving. People stopped traveling. We didn't go out to eat as much, if at all. And so the company did drop, but as you can see, it rebounded nicely, and it's continued to grow since then. And that shows how resilient this business is, to grow from a global pandemic to growing to 11, 12, 14, 16% over the last 5 or 6 years. So very, very, very resilient business. And that's another reason why I have been so bullish on this company. All right. So latest quarter. So the latest quarter they did 11.2 billion. Fiscal 20. I'm sorry, fiscal quarter two, 2026 did $3.31 in adjusted EBITDA. I'm sorry, adjusted EPS. Uh, I guess a question you could probably ask about Visa is it still working? And if we look at the numbers, yes, the company is still working. It has beat the earnings projections over the last 39 of 40 years. This is a company management wise, and they recently just went through a management change. They promoted a new person to CEO a couple years ago, as well as a new CFO. And so the company has a history of kind of under promising and over delivering, which is something that you definitely want in a compounder. And so this is a company that continues to set high goals, but maybe not too high that they can't achieve them. And they can continue to keep growing and improving year by year by year. And when I say that they're beating the earnings projections, they're not doing the GE Jack Welch thing where it's like beating by a penny every single quarter and manipulating the financials to be able to do that. They are legitimately beating the earnings projections that are set by the analysts as well as the company, and that is indications that they are a strong business that continues to evolve and grow as they go forward. So DCF, or so our free cash flow. So this is the metric that I think really matters to investors and why this is so important for dividend investors. So as I mentioned earlier, the company generates around 43 billion in revenue, and they're generating almost 21.6 billion in fiscal 2025 and are growing on that in 2026 to free cash flow, which means that this is the kind of the fuel that the company can continue to use as for dividends as well as buybacks. And it also shows that because of the margins that the company is able to generate, they are able to grow a lot of free cash flow, which is great for us as shareholders because that means they can put a lot of that money back into the tank for buybacks, for share repurchases, if they want to invest in the business. It just gives them a lot of optionality. And that is one of the things that you always love to see. All right. So Visa is, when we talk about capital returns, this is something that's very important. So the company is in a phase four, which means that it's in a capital return phase of the company. And it is able to generate quite a bit of cash, as we talked about. And the company is continuing to grow and grow and grow. And it hands back a lot of cash to us. As we can see on the chart here, that in fiscal 2025, it returned 18.3 in buybacks and 4.6 in dividends. So that totals 22.9 billion in cash that they've given back to the company. The buybacks are a huge driver of the returns of the business, and we'll talk about that here in a few minutes. But the company has done a fantastic job of returning cash as shareholders, and that's another reason why I'm a very bullish on this company. And you'll notice that it is greater than 100% of the free cash flow for fiscal year of 2025. And that means that they are dipping into the cash reserves that they have on their balance sheet, which is no big deal because this company grows so fast and grows so much free cash flow that they can afford to do that from time to time. So that's another reason why this is such a strong business. So as I mentioned, the share count has been dropping. As we noticed, they spent 18.3 billion on buybacks last year. So over the last 7, 8 years, they've reduced their share count by 15.5%. That is huge. And the reason why this is huge is let's use an analogy. So, pizza, my favorite food. One of the easy ways to think about this is a pizza generally comes with 8 slices, right? Well, the fewer the slices, the bigger the pie, our share of the pie gets. So let's say that you buy a pizza and it's 12 slices. You get less of the pizza as you eat each piece. But if it comes in 8 slices, now your share of the pizza is bigger. And if it goes down to a quarter, like that's like the dream, right? Then you get an even bigger slice of the pie, but you're still paying the same price for the pie. So if you pay $15 for a pizza for the pie for the pizza, and you get 4 slices, then you're getting roughly a quarter of the $15. So $3.75 ish, if my math is probably wrong. Then you get a bigger share than you would if you had 12 slices for the $15. So that is why this is such a huge advantage for a company like a MasterCard or a Visa, is that because they generate so much free cash flow, they could reduce the slice of pie of the pizza, and it gives us a bigger share of each pizza. And as we get a bigger share, that also increases the dividends per share that we get, because we get a bigger chunk of the pie each time they reduce the share count because of the share price and how that works. So that is another reason why this company is such a strong business, and why I love Visa. All right. So this is, I think, the biggest part that we want to talk about for dividend investors. So, when you look at, most dividend investors are focused on the yield, which is important for sure. It's a big part of how we get our returns for companies we invest in dividends. And one of the reasons why a company like maybe a Visa, a Microsoft, a Mastercard might get ignored or overlooked is because their yields are very small. Generally, it's 0.8. It's less than 1% generally. And those are not as attractive, obviously, if you look at Income Realty, which has a yield of a little over 5%, or some of the other REITs that are maybe 6, 7, 8%, or maybe a company like a Procter and Gamble, which has around 3.5, 4% yield. Those are far more attractive to dividend income investors than a company like Visa. And why I probably yield, or I lean more towards a company like a Visa and MasterCard, is this concept of yield on cost. And if it's something you're not super familiar with, we'll break it down here in just a second. So when we look at Visa's yield, or we look at their dividend payout growth, they've grown their dividend around 17% a year over the last 10 years. That's a very, very fast. And what that roughly means is that their payout doubles roughly every 4.3 years. And if you buy it at 0.8%, which sounds like, yeah, that's really not much, and you hold that for 10 years, 10 years, your yield on cost is starting to push 4% on a much bigger position. And that is where this starts to become very, very attractive. The company is only paying, their payout ratio for earnings and for free cash flow is around 20, 25%, generally in that range. And that is very, very low, which means that the company has huge room to continue to grow. And as it continues to grow its dividend, it also grows the yield on cost, because as the price continues to appreciate, then the value that you generated from buying it at a lower cost starts to grow, and your yield on cost continues to grow. That's one of the big reasons why Buffett was so attracted to Apple, is that they started they reinstated their dividend in 2012. And when he started buying the company, it was at a very, very low cost. His PE on the company was 8, 10, 12, for a company of the quality and size of Apple. And the yield on the dividend was very, very low. But by the time he started selling it off 5, 6, 7, 8 years later, the yield on cost had grown tremendously. And so he was generating very, very large returns from just the dividend, including the share appreciation that he got, as well as them reducing the share count tremendously over that same period. So all those things kind of combined to make something like an Apple a monster investment for Buffett. And the Visa and MasterCard offer the same opportunities because the company continues to grow, the share price continues to grow. They reduce their share count, which helps grow your return as well as your dividends. And the yield, even though it's low and small, as those things all compound on each other, your yield on cost continues to grow, which makes it a very attractive investment going forward. And so that's one of the reasons why, when you're looking at dividend growth, it beats dividend yield for long investment horizons. Now, I'm going to caveat all of this by saying that if you are, let's say you're closer to retirement. So I'm almost 60. So let's say that I was 68 years old and I was on the verge of retiring. Would I hold Visa as a 10 or 15 or 20% uh, portfolio size in my portfolio? Probably not, because I would want to have more stable, secure dividend payers that are going to generate income for me. Think of a company like McDonald's, for example, which is not growing as fast as Visa is, but is a very stable, reliable. People are going to continue to buy cheeseburgers from now until eternity. And so that offers a different kind of return and a different kind of stability, because nothing would suck more than going into retirement and have the market crash and having something that is a air quote riskier crash more than something that's maybe more stable, like McDonald's or a Walmart or a Procter and Gamble. And so this all has a bearing on where you are in your timeline of investing and how long you want to continue to invest as you go forward. So would I eliminate Visa? For me, no. The risk tolerance, I have a higher risk tolerance than maybe other people might. And so Visa would be something that would definitely fit comfortably in my wheelhouse as I'm getting closer to retirement and even into retirement. Because another thing to kind of caveat to think about is that with today's technology, with today's medical advancements, we are living longer than my parents were and where their parents were on average. And so that means that when we go into retirement, instead of maybe having our money have to last 5 or 10 years, now it has to last 15 or 20. And so as we get farther into retirement, we have to be able to have our money generate income and to continue to grow to generate income. And so those are things that, if you're really interested in this, definitely talk to a financial advisor. I am not one. So, full disclosure, I am not a fiduciary in that respect. I don't know what your situation is, so I'm not trying to give you advice. I'm just basically relaying how I would think about it and how I think about it. And so those are things you definitely have to take into consideration when you're building your portfolio and deciding how big of different positions you want to have in your portfolio. But I definitely believe that Visa has earned and should have a position in people's portfolio because of the strength of the business, as well as the dividend that it can produce and the returns you can get for that dividend as a dividend growth investor or a quality investor. All right. So valuation. Visa is never cheap. It's never been cheap. It's never going to be cheap, in large part because of the quality of the business. People are willing to air quote pay up for the company, and that is something that continues to happen as people go forward with the business. So right now, the company is trading roughly in a range of around 28 times earnings. Expensive or fair? That is a hard question to answer. For me, I believe that the company is pretty fairly priced or maybe even a little lower right now because it's been beaten down over the last 12 months. So the PE right now is, 22 to 25, give or take. I feel like the company is maybe on the cheaper side, and that's why I'm adding to the position for me personally. But I also kind of dollar cost average into a company like Visa, so I take smaller bites of it regularly so that I can build up my position. Right now, the company is around 4.5% of my portfolio. My goal is to get it to around 5% or so and let it kind of hover in that range. But wherever you are in that, it's never going to be cheap. So if you're waiting for it to get to a 15 PE. If it gets to a 15 PE, there's something very, very wrong going on with the company or in the market. And so that is something to definitely keep in mind. Another thing that is also to kind of throw out there when you look at a company like a Visa or a MasterCard or even a Costco that are never, ever, ever, ever cheap. If you look at the company like a Visa or a MasterCard, the company has never traded below probably a 25 PE, give or take, over the last 15 or 20 years, but you've also generated at least 12 to 15% returns over that same period. Same rule applies with Costco. The company is never cheap. And right now it's very expensive, but it's never cheap. But if you look at the returns that people have generated over the last 10, 15, 20 years, they've been, market beating returns for Costco. And so that is why sometimes you have to look at where the company is relative to others in the market, as well as to peers, as well as to their historical average. So whenever you're doing any sort of valuation work or any number work at all, always look at a wide range of different kinds of numbers. So never just take one number out of context. We talked about that last week on ROIC. And when you're looking at valuation, same rule applies. Don't just look at, okay, what is their current PE and make a decision on that. You want to look at what is the current PE now. You want to look at it 5 years ago, 10 years ago, compare it to MasterCard, compare it to possibly American Express, maybe compare it to other payments companies in the industry. And so you can kind of get a range of where they sit within those. They call this relative valuation. And that's why, because you want to relate it to other you want to relate it to other trends. You don't just want to look at it on a standalone number because that could lead you to making a mistake thinking, oh my gosh, it's super, super cheap. And if you don't really understand the business and maybe there's something drastic or tragic going on with a company, you could possibly make a mistake and buy into it at a really, really high price. So again, and also all of this revolves around your risk profile and what you're comfortable with all of this. So that's kind of how I think about valuation. So Stock Simplifier is a tool that's been built by the folks at Long Term Mindset, Brian Feroldi, Brian Stoffel, Brian Withers, and Justin Lamb. And this is a system that I use to go through and do a deep dive on companies. And these are the different categories that you can rate. And so, as you can see, I gave it a 4.3 out of 5. The business, I'm excited about it. Management, great management. Growth average is growing around 10, 11%, which is, I think, pretty average. It has a very, very wide moat. Valuation, I feel like, is attractive. And the risk right now, I feel, is moderate. And we're going to talk about that here in just a few moments. So that's kind of how I grade Visa overall. This is a great tool. It allows you to go through any company that's in the S&P 500 right now, and they're working on expanding to other parts of the world. But it's a great program and a great tool that you can use you can find it at stocksimplifier.com. All right. So let's talk honestly about what could break this. So, as excited as I am about Visa, I have to acknowledge that there are potential downsides. So, what could break the toll booth? I'm going to actually work in reverse here. So we got a one, two, and three. So number three is smart money moving. You may or may not have heard, but when Greg Abel took over, the latest 13F from Berkshire Hathaway indicated that they withdrew from quite a few number of companies, and Visa and Mastercard were also part of that move. The reason why was because Todd, no Ted. I always mess them up. Ted and Todd, the two T's that were the investment guys that Buffett had hired. One of them left to go to JP Morgan. I always blank on which is which. Uh, all of his investments were removed from the Berkshire equity portfolio, and Visa and MasterCard were among those. So that is a big reason why they exited those two positions. They also were very, very small positions, honestly. So they were not big parts of the company. So to me, that is less of a breakage. Probably the next level is stable coins and local rails. Now, stable coins is a crypto that is being used to move money. It's very fast, it's very efficient, it's a lot cheaper, and it's able to do cross-border transfers much quicker and much cheaper than the current system that we have in place now, which is mostly run by the banks through the SWIFT system. If anybody's ever worked in the banking industry and had to do wire transfers, for example, that's kind of how that works. It's laborious. It takes forever to do. And if you make any sort of mistakes, it could be very, very, very painful to fix. Now, stable coins has come along and offers an ability to kind of circumvent that. And so that is definitely a Visa and MasterCard both make a fair amount of money from cross-border payments. Most of the well, I wouldn't say most. I don't. We don't have numbers on the actual breakdown of that, but I'm gonna let's just say 50-50. 50% of it is retail. So you and I going to France and buying a coffee and paying for it at the local coffee shop, and then it hits our bank, and that's a cross-border payment. They make Visa and Mastercard make more money on that transfer. The 50%, let's say, would be enterprise. So if you subscribe to Netflix in France, that payment that would hit the bank account here in the United States would go through Visa. It would go through international rails and is much more expensive. With stable coins, Netflix could transfer that, could make that payment, if you will, to the bank that would hit their bank here, and that would be much, much cheaper. And so that's an enterprise level. And so if those things, what Visa and MasterCard CEOs have both said in the last two earnings calls is that retail wise here in the United States, they are not seeing any sort of adoption or really even a need for adoption for stablecoins on the retail level. And so that to me assuages the stablecoin, I guess, effect on retail usage. Enterprise, however, that is definitely seeing an increase, and I think that will continue to accelerate because these companies are looking, on Amazon or a Walmart, for example, they're going to look for ways to save money. And that is one of the ways that they can do that is by using stable coins to make cross-border payments or transfers for large amounts of money, which will save them a lot of money. And so that makes a lot of sense. One of the ways that Visa and MasterCard are trying to counteract that is they are working on technology to try to build that for themselves. And so that is one of the things that they are doing to try to kind of circumvent that. The other, I guess, fear is local rails. So FedNow, which is a new thing here in the United States the last few years, has been by and large kind of a dud. It really hasn't been adopted much here in the US, which is not, I don't think, a big surprise. When you see things like UPI, Union Pay, Pix around the world, Pix is in Brazil, UPI is in India, and Union Pay is China. Those are government-led rails that are being adopted very quickly and used a lot. I traveled in Brazil. I saw Pix everywhere. I know Brazilians have adopted this, but we also have to remember where they are in the technology upswing. The United States is, iPhone penetration, for example, has been here for over a decade, and we're in Brazil and other parts of the world. Though the adoption is has been a lot slower, and so they are more open to using different kinds of payment opportunities on their phone than we are here in the United States, or adopting new rails like Pix or something like that, where we're very set in our credit cards, our credit card points, our debit cards from our banks. All those things are very set. And so the adoption of those things here in the United States are much, much slower. The last big, I guess, risk is regulation. And this is really the biggest one. What could happen and what is going on is the Durbin Amendment, which was established about 8 years ago or so. What it was, the Durbin Amendment was a something that ran through Congress that allowed put a cap on debit card fees. And so this was a hit to banks. It was also a hit to Visa and MasterCard. The reason why they established this was they felt that the fees were too high and they were harming merchants and they are harming us as retail consumers. And so the idea was to put a cap on these debit card fees, which was supposed to lower the cost for us as retailers, as well as the retail consumers, as well as the retailers. Now, what happened was is that the money it did put a cap, but the break, if you will, the extra profit went to the retailers, not the consumers, and so it didn't work as intended. And you can't blame the retailers for this, but it just didn't work as intended. Now, what's happening is that they're trying to put a cap on all fees, and Visa and Mastercard are obviously lobbying against this, as well as the banks. And so, what's happening is it's caught up in the legal loop. And right now, it looks like the judges are going to uh, vote in favor of Visa and Mastercard at the moment, but it probably is going to go all the way to the Supreme Court. So this has a long ways to run, and Visa and Mastercard have shown over the years that they're more than willing to work with regulators as well as other government agencies as well as other businesses to try to make everything work as seamlessly as they can. And so I am confident that they will be able to figure something out as we go forward. So there's lots of other strings we can pull on this, and I don't want to bore you with all the details, but that's how I'm thinking about some of the risks that are involved in this company. So, long story short, Visa turns half of every sale into cash and hands nearly all of it back to shareholders. So it has a fast growing dividend hiding behind a small yield. And that is one of the big reasons why I think this is a great dividend investment stock. And that's, I guess, the the gist of our whole conversation today. So let's I'm going to turn off the sharing and let's open it up for any questions and see if you guys have anything that okay. So in the future, if you want to ask any questions along the way, during the presentation, I'll generally talk. I've gone a little longer than I would normally like, but Visa gets me excited, so I apologize for that. But you'll be able to see that you can ask any questions, and I can go through the live chat after we're done with the presentation, and I can try to answer any questions that you may have about Visa or anything else investment related. If I have full disclosure, if I don't know, I will tell you I don't know, and I'm not going to blow smoke up your butt, so to speak. So I'm just here to help. All right. So I guess the last thing I wanted to talk about before we sign off is Dividend School. If you're not familiar with it, you can go. It's a free investment. We do have a paid service, and the paid service for Dividend School offers investments. We have education, of course. We have infographics that are included in that. And that's I'm a visual person. I love to learn visually. So I've created these infographics that can help you learn. As well as the infographics, we also have a dividend universe that I follow. So around 20 stocks right now. And I think, are probably the best dividend investments. And they have a wide range of things from compounders like a Visa or MasterCard to REITs to tech companies to things in the semiconductor space. And so there's lots of great opportunities in there. The dividend universe, I send out 5 best buys every month, and we have some of those coming up here in the next few weeks. I've also created a buy first portfolio of 5 companies. So if you're brand new to dividend investing or just brand new to investing and you're looking for some suggestions of companies that might be a good fit to start investing, you can get that, and all that is behind the paywall as well. In addition to all that, I do a monthly deep dive, much deeper than what we talked about today. And we have one coming up in next week, actually, and that'll be released. And that's all behind the paywall. And these are all things that you get as being part of Dividend Pro. So, if you're interested in dividends at all, if you're interested in education on the stock market, I'm here to help. And you can check it out, dividend.school.com on Substack. And with that, I'm going to go ahead and sign us off. You guys go out there, have a great week, and stay safe out there. And we'll talk to you next Thursday.